Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about the losses that are being incurred by Chinese companies. I've been talking about the problems in the Chinese economy, well, for the past few years, but particularly over the last 12 to 18 months, I've been referring to the fact that it's estimated that around 50% of all companies in China are now making losses. And lots of people have asked me to expand on this. So in today's video, we're going to go through some of the problems that are being encountered in China right now. Now, if you follow the channel, you may have seen my recent video where we talked about what's happening with exports, because China is geared up for exports. That's what it does. It makes things and then it exports those things at a very low cost all around the world. So the whole made in China concept, that's basically what it's all about. They make things at a very low price because they have a low cost of labor. They've got huge mega factories, so they can produce really good economies of scale, produce things for a much lower price than you're able to at most other countries. So that's essentially how the business model works. But unfortunately, it's not working at the moment. You can see from this chart that in October, exports fell by 1.1%. And that is an absolute disaster for a country that is basically geared up for exports. It needs its exports to continue growing every single month. And you can see that this is the first time that exports have actually fallen since February of 25. And that was when the month after Donald Trump took over as president. He took over on the 20th of January. And clearly there was major concern amongst all of the Chinese companies and also all of the US businesses and other businesses worldwide that were dealing with Chinese entities. So October represents a real worrying time for Chinese entities, because if exports continue to fall, then that is going to really hurt many Chinese businesses. And the other market that China sells into, if it's not exporting, is obviously its home market. It has 1.4 billion people. It's a very big country. And so the alternative, if you're not exporting, is to sell everything to Chinese consumers. And this chart shows the month-on-month movement in retail sales in China. And as you can see, things have not been going well. Well, they've not been going well at all, really. This is the last 12 months, and I was about to talk about the last 4 months. But one thing to note about this chart is that the scale on the right-hand side goes from 0.6% positive at the top to 0.3% negative at the bottom. So we're talking about quite small movements anyway. So even the positive growth numbers here aren't massive. But if we do zoom in and have a look at what's been happening over the past 4 months, you can see that in June, July, and September, retail sales fell month on month. So Chinese consumers are spending less than they were at the beginning of 2025. So what that means from Chinese companies' perspective is that exports are going down and home market is also going down. So both of your markets are in decline at the moment. So clearly that's bad news. Now, the other factor to take into account here is what's happening with producer prices, the price of a product when it's leaving a Chinese factory. And this chart shows the movement in producer prices over the past 12 months. And the scale on the right-hand side starts at 0 and goes down to minus 3.7%. So you can see that in every single one of the last 12 months, producer prices have been falling. They came down by 2.1% in October. And if we expand the scale of this chart to show the last 3 years, you can see that they've actually been falling since October 2022. So that's more than 3 years. And so there's a cumulative impact there. If your prices fell last year and then they fell again this year, that's obviously double whammy, but it's been going on for 3 years. And over that period of time, costs have been going up. Wages have been rising, rents have been rising, fuel costs have been going up, raw material prices have been rising. So when you've got rising costs and falling prices, that means that your profit margin is being squeezed, and actually it's been wiped out for many Chinese businesses. And so this is a real nightmare situation to get yourself out of. Now, Bloomberg has undertaken a huge investigation into what's going on in China. And this graphic highlights what's happened to the price of a variety of different products between the first half of 2023 and the same period in 2025. So over the last 2 years or so. And you can see that wine on average has come down by 29%. BYD cars, and that's the market leading brand for the electric vehicles, BYD recently overtook Tesla in terms of global sales of its cars, the volume of sales, the price of those have come down by 27% in the last 2 years. House prices in major cities also down by 27%. And we've talked a lot about what's been happening in the property market in China. I'm sure you'll be familiar that the huge house builders, the property developers, a lot of those have gone bust. Many of them are in severe financial difficulty. They can't even afford to pay the interest on their loans. And so the property market is completely bust at the moment. Nobody wants to buy property, so they're having to slash the price. And when you compare that to most other major cities around the world over the last 2 years, there has been a real increase in prices. So China is operating in a completely different sphere to the rest of the world. The price of potatoes is down by 17% over the last 2 years. Beef down by 14%. Eggs also down by 14%. Rent in major cities down by 9%. So if you were hoping that you could get out of jail by renting out the property that you'd bought a few years ago that's now underwater in terms of its price, then that's not really going to help you either. And microwaves are down by 8%. So this is just a selection of different items to show you that it's not one particular sector in China that's suffering. It's everything. Everything across the board is down in price. And Bloomberg have calculated that more than 25% of the listed Chinese companies reported a loss in the first half of 2025. And that's the highest share in at least 25 years. In fact, it's probably the highest in China's history because we don't really have reliable data that goes back more than that period of time. And this chart shows a breakdown of how much these companies are losing. So the scale on the right-hand side shows the percentage of listed companies that are making losses. And then we've got a color coding here. The black section at the bottom shows those companies that are losing more than 10%. The darker grey is between 5 and 10%, and the light grey but up to 5%. And across the bottom, we've got the years between 2000 and the first half of 2025. So what you can see here is a very clear trend to an increase in the loss-making percentage. So back in 2010, we were looking at around about 5% of listed companies were losing more than 10% profit margin. Today, that's more like 13%. So we've seen a rapid increase. We've also got an increase in the numbers losing between 5 and 10 and between 0 and 5%. Now, you may have heard me say before that over 50% of companies in China are now thought to be loss-making. And this chart says 25%. So you'd be thinking, well, you're talking rubbish, Joe Blogs. But this is only the listed companies that Bloomberg have been able to get data on. So these are the companies that you can buy shares in that are listed on the stock exchanges in China. Now, they are the biggest companies in China by definition. You don't tend to list on the stock market unless you've got to a certain size. So 25%, well, more than 25% of the biggest companies in China are now reporting losses. And that's in the first half of 2025. We don't have the latest data, which backs up everything that we've been talking about in today's video about what's been happening in the last few months when things have got materially worse for Chinese businesses. But the reason why it's more than 50% across the board is that the majority of companies in China are not listed on the stock exchange. They're privately owned. And those companies tend to be smaller, and therefore they have been affected much more severely than the big companies. A big company, by definition, is a big player. So it will probably be able to do better than smaller companies when things get tough. The smaller companies are really suffering right now. So that's why more than 50% of companies are making losses, because these are the bigger examples that Bloomberg have been through. But the smaller companies are really in a world of pain right now. And if we look at the split of what sectors these losses are spread across, you can see that it's right across the board. It's not limited to just one or two areas of the economy. So here we've got a spread between industrials, materials, technology, consumer discretionary businesses, healthcare, consumer staples, real estate, which is probably the worst affected. You can see the black section for real estate is the highest out of all of these different companies. And then we've got communications, energy, and utilities. So even infrastructure related businesses are currently reporting losses in China. So that tells us that this is right across the economy and that no company is exempt from what's happening. And this chart shows what's been happening with the profitable listed companies in China. So, what you can see here is a significant decrease in their profit margin. The shaded section at the top of the charts here shows the reduction in the profit margin that's been experienced. So, over the last 2 years, all of these companies have seen their profit margins going down. And obviously, the longer that continues and the more the profit margin decreases, the more likely it is that they will then move into a loss making situation. So we're not seeing certain companies booming at the same time as others are moving into losses. Everybody is seeing less profitability and therefore less cash flow. And that's a problem if you've been taking on debt because you've still got to pay for all of your interest. And if we have a look at this chart, it shows the share of companies whose profits can no longer cover the interest on their debt. So this dates back to 2014, and the scale on the left-hand side goes from 0 at the bottom to 50% at the top. Now, you can see, hopefully, that there's lots of sort of light grey shaded lines in the background here. So Bloomberg plotted the details for every single sector, and real estate was right at the top, not surprisingly. More than 50%, around 60% of real estate companies that are listed in China don't make enough profit to actually pay the interest on their debt. Energy companies were also very high on the list, more than 40% for those businesses. But overall, you can see the black line that's been plotted through the chart. Back in 2014, around 20% of companies were not making enough profit to pay their interest. Today, that's sitting at around 35%. So 1 in 3 of Chinese listed companies don't make enough profit to pay the interest on their debt. And actually, this data only goes to the end of 2024. So it doesn't take into account what's happened in the past 10 months or so. And as we've seen, it's got worse in the past 10 months. And it's actually got significantly worse in the past 6 months. So this trend is on the rise. And it's likely, if we had the very latest data, that we could be looking at more than 50% of companies that are listed in China not making enough profit to cover their debt. And as we previously discussed, the smaller companies that are not listed are actually worse off because they're suffering the most. So we could see some really worrying numbers coming out of China if we had the latest data. But unfortunately, we don't. We just got to work with the 2024 data. And in terms of staff cuts, which companies are sacking people, getting rid of staff, this chart shows the data back to 2014. So once again, 0 to 50% on the left. And you can see back in 2014, just under 30% of firms were reducing their workforce. Today, that's sitting at more than 40%. So there's been a sharp increase since the COVID pandemic. So that's quite interesting because you would have thought that it would have gone the other way, that during the pandemic, then they would have laid people off and then everybody would have been hiring heavily over the past couple of years. But that's not the situation. And once again, this only goes to the end of 2024. So if we're looking at 25 data, that could easily be above 50% for all of the listed companies. And if we look at what's going on with regards to investment, how much companies in China are spending on capex, so capital expenditure into new equipment, or research and development, so helping develop new products and ideas. This chart shows the stats going back to 2014. And interestingly here, this goes from minus 20% on the left-hand side to plus 30%. So back in 2014, on average, Chinese companies were spending around about 5% increase on capex and R&D year on year. That actually rose to a peak of around 25% after the COVID-19 pandemic, when there was big investment back into all of the companies when they reopened again. But as you can see, over the past few years, it's come down significantly. And the latest data for 2024 shows that there's been a year-on-year contraction in capex and R&D expenditure. So it's down by almost 5%. Now, that's not good news, because when you've got an economy that's struggling, when you've got businesses that are making losses, you really need to try and boost them, to do something to try and help sales and profitability. But if you're cutting back on expenditure and investment into new ideas, then that doesn't help you going forward. So the signs here are really bad for Chinese businesses. So, what's the summary and conclusion today? Well, I wanted to post this video because I've mentioned a lot over the last 18 months that lots of businesses in China are now making losses. And I've had lots of comments from people saying, can you please give us more information on that? We'd like to hear the details. So, in today's video, we've been through some of the data. This was for listed companies in China because that's really the only reliable information that Bloomberg could work with. What they've identified is that more than 25% of listed companies in China are now reporting losses. Well, this was actually for the first half of 2025, so it doesn't take into account what's been happening over the past few months. And as we've talked about, over the past few months, things have got even more difficult for Chinese companies because many of them rely on their exports. That's how they've geared up. They've basically built these mega factories to produce millions of different items for sale, which they then export to countries like the USA. The USA is the single biggest market for Chinese exports. In 2024, China exported over $450 billion worth of goods. So the problem that Chinese companies are encountering is that, firstly, Donald Trump has imposed lots of different tariffs on those Chinese imports to try to make it more of a competitive landscape for American businesses and also to cut back on the amount of profit that China is making out of the US. So that's hurt a lot of the exports because when your price goes up, then generally demand goes down for your product. So that's what's been happening. But also, Chinese businesses have found that other markets around the world, the European Union, Brazil, lots of different countries, Turkey, have been looking into the price of Chinese goods and imposing their own tariffs to try to make it fairer for their local competition. So, China has seen a pushback in terms of demand for its products. So, as a result of that, volumes have been going down. But in addition to that, we're also seeing producer prices going down. They've been falling for the past 3 years. And that's a problem if you're constantly selling things at a lower price, but all of your costs are going up because it eradicates your profit margin. And that's what's happened over the past few years. And Bloomberg has identified that more than 25% of listed companies in China are now banking losses. However, when you look at what's happening with private companies, they are smaller and more vulnerable to these changes in demand and the reduction in prices. So, more than 50% of Chinese businesses, when you take into account all of the private companies that have been heavily impacted, are now making losses. And that's obviously really bad news for those companies, particularly when you take into account that many of them have lots of debt. And as we've seen, it's now estimated that over 30% of all companies that are listed in China don't make enough profit to actually just pay the interest on their debt. And that's now referred to as a zombie company because you're basically just the living dead. You're making all of your profit and you're giving it all to the bank. You're not actually making any profit for yourself or your shareholders. You can't distribute any profit to your staff. And as time goes on, as debt costs rise, then it's likely that you just move into a loss-making situation because if you can't even pay your interest on your debt, then at some point you may just give up and the business gets liquidated. That generally is what happens with a bank. At some point they say, actually, we're not going to get our money back here. We just want to enforce and get as much as we can back and then move on to doing something else. So the warning signs are there for many of these businesses in China. They've taken a lot of debt. They're not making profit. Their markets are falling. Their prices are falling. And it's really difficult to be able to turn that around because you're not in control of any of those issues, particularly for Chinese businesses that are operating in mass consumption markets around the world, where generally there's lots of competition against the Chinese product. So the overall summary of today's video is that what we've seen from the data produced by Bloomberg is that over 25% of listed companies in China are now making losses. That's more likely to be more than 50% when you take into account smaller private companies across the whole of China. That is not a good bedrock for the Chinese economy. Those businesses will not be contributing any tax to the economy because they're not making any profit. Therefore, GDP is now in decline in China. And there is a major question mark as to whether China can make it through the rest of 2025 and deliver the 5% GDP target. But more importantly, many companies in China are on the verge of going bankrupt because they're making losses. It's unlikely that this situation will turn around any point in the near future. And we could see a massive increase in liquidations and bankruptcies in China if the banks enforce on that debt. Now, the Chinese government may well decide that they don't want the banks to do that and tell them not to do it. But we've now got a huge number of zombie companies in China that don't even make enough profit to pay the interest on their loans. And that's a really serious situation, not just for those companies, but for the Chinese economy. So hopefully you've enjoyed today's video, you found it useful, informative, and hopefully thought-provoking. If you've liked what I've said, then please give me a thumbs up. Please subscribe if you haven't done so already, because I'm trying to increase my subscriber numbers, so you'd be doing me a favour if you hit that red button. Thank you for watching this video all the way through to the end, and thank you so much to everyone supporting me. If you bought me a coffee, sent me a YouTube super thanks, thank you so much. And if you've signed up as a Patreon or a YouTube member or Buy Me Coffee member, thank you for that support, really appreciate it. And here's something to put a smile on your face.